Thanks for inviting me. I appreciate Orlin and Missy for letting me come to your place, your beautiful office, and talk a little bit about presenting the perfect pitch, or creating the perfect pitch, really, for any product or business that you've created. Trevor Welch, I'm managing partner of TAVA Capital. Josh Rodessa works with me. He's the principal and CFO and in charge of a lot of the accounting structures of what we do. TAVA is a private investment and consulting firm. It specializes in certain sector niches that we kind of focus on. For the last 10 years, I've been investing in hedge funds, private equity, direct deals, direct strategies on both, and also working with other managers that are in those areas. So I've been across hundreds of private companies that we've looked at for investment, and literally thousands of hedge fund managers and strategies that we've looked at and worked through and talked to. So as far as being pitched to, I have a lot of experience. Being the expert at it, I don't know. I just know what I liked and what I didn't like, and that's what we're going to talk about tonight. So I don't intend this isn't going to be a boilerplate, use this template, use these statistics, and do that, because it's different for different businesses. And quite literally, I care about it very much, but then when I look at what I've actually invested in, sometimes it didn't even come to play. But what we're going to talk about tonight is to reduce the probability of you being eliminated based on something you just miss. Some of the things that we see in a lot of pitches that are just obviously a little breaking point. So we'll give you some tools and some structures of maybe how to get away or get around that I recommend. So what is the perfect pitch? It's a rhetorical question, so I'm going to answer it. It is literally whatever gets you the funding your business needs, at terms you can live with, that you're happy with people that you can see yourself spending the rest of your life with. And I mean that literally, because a lot of times these investments last a long time. I'll actually hand out a slide that gives some statistics on the average venture investment versus the average marriage, and I'll let you be the guess of which one lasts longer in America. And so it is. Be sure you like who you're invested in, but at the end of the day, you need the funding you need, and it's important to get that business done. One way I recommend, we're going to talk about 3 different things on how to do this. The first is going to be, make sure you focus more on the message that is being received than the information you're providing. Nobody doubts that you have plenty of data. Nobody doubts that you have all that information, but most of it that is presented is irrelevant to the key points that people need to make a decision of whether they think this is a good opportunity or not. And so while what I'm presenting applies mostly to like investor meetings, if you're looking for financing, if you're looking for just help in your company, it applies more to that side, but these principles I think will apply to anything if you're in a product pitch, to a business, to a partner, to other units that you're looking to do business with. Use these same things to get that engagement. The key is to have people have confidence that you can execute and do what you're telling them you can do. So the key that we're going to talk about first is focusing on the information or the message that gets received over the information provided. Second, I recommend you look at a pitch. When you're developing your pitch, look at it more as an elimination game, not a selection game. Oftentimes when we have these meetings, we're saying, pick me, pick me. But that's not really how the investor mindset goes that I'm aware of, or that mine goes at least, and the ones that I know of that I connect with a lot. Think of it more like the Hunger Games, not the prom. You're reducing the probability that you're being eliminated. And we'll talk about that. I'm not saying that investors are just looking to trick you up or trap you and eliminate you. It's more just how the mind works in the investment process. And then third, we'll kind of delve a little bit further into the investor mind, what they expect to see, why they expect to see it. You look at the sharks, and that people think they're sharks and they need a big percentage. We'll talk about sometimes why that is in the risk-return perspective that you're competing with, and some of that. Before I go on to the message, have any of you pitched to investors before, like an investor group for your product or business? Yeah. How was that experience?
I was really nervous.
Yeah.
It was like my first time doing it.
Is there anything you learned or anything that you have questions about or concerns about?
So I learned not to not to get too close to people because I got all excited, so I was like really up close.
Really?
I don't know. That's how I felt. I felt like they were like kind of like leaning back because I was like so intense.
A little bit, yeah.
I was like way up close.
Overbearing?
I was overbearing a little bit. So yeah, to be, not overbearing.
No,
But just the right amount.
I think that's
the right
great.
amount of your tone and all that kind of stuff. So.
I don't think that would have excluded you from being invested in, and I'll tell you why. A lot of times people think that there's a particular personality you should have. You should have a great presentation style. You should be totally refined in everything you say. Honestly, I cannot think of a personality style or a communication style that I've looked that excluded people, except maybe the overly refined, like, you picture, no offense to anybody, but like somebody up on stage at a multi-level marketing conference, that's overly boisterous and on point and super, every hair is in place. And honestly, that's the only one I can think of that you look at and you're like, I don't trust this.
Too polished.
But yeah, and especially in the hedge fund world, I mean, you literally meet with people that have incredible capabilities and intelligence, and you trust that despite that they have probably social disorders and problems. I mean, the opposite of what you would think would be a great presenter, you can look through that, and most investors absolutely do, and look for that to what is the key value that this entrepreneur is bringing. We'll have a Q&A at the end. Is there anything that anybody particularly wants me to cover during the presentation that's imminently important for you to understand on pitching to investors? If not, yeah, go ahead.
I'll wait till the end. So
Okay.
it's kind of covered.
Yeah, well, join us, Brandon. We will have a Q&A at the end, so if you do have existing questions, we'll go over that. First off, So first off, something I recommend in order to kind of fashion this message so that it keeps the investor or the person you're pitching to engaged is structure your pitch like it's a story, an interesting story. Think of how you would write a book or write a movie or write a story that would engage the person and bring them right in. Think of a trailer. What's that garner to do? It's to capture that key point you want the people to see and be interested in and want to know more about. So what is the villain? What is this problem that you're fixing, this pain point? What is the problem that puts a gap that your product or service can fill and have an economic advantage? That's what they're looking for. Is what is that economic piece that can be garnered from the value that you're providing? What's that quest? Maybe it's a journey. Maybe it's something that's never been done before. You're saying, I can do this. This has never been done before, and this is how we're going to conquer it. And then you can introduce your product, your hero, your part of the story that compels them. Investors love to see dynamic changes coming and occurring, and it either needs to reinforce something they believe is already happening as a change or as a problem that exists, or that they believe is a change that will come based on the information you're providing them. So think about that. What is your story? If you were to put this on a storyboard, when I say I don't think that there's an ideal template or platform for these pitches, it's business to business specific. But if there's a business you respect, there are like 170, 180 unicorns right now. One new one just got put in the unicorn slot. Betterment, the investment group, I think this week, is valued over $1 billion. But there are tons out there where their slides are available. I would recommend just going to a company that you respect and seeing if they have slides or a platform. And I'm not saying copy what they've said, but as far as the overall flow and structure, if they've had $1 billion valuation, they've done something right on their pitches. And so it should flow well enough that I would recommend finding one you like and kind of modeling after them. But otherwise, what you're trying to do is build this story in a picture framework where, kind of like a trailer or a book, the investor's coming along with you in this story of what is happening, what needs to happen, and what you can do to provide that opportunity for this benefit. And so the more you can structure that, one way that I would frame, that I've used as a framework before, is a marketing strategy called 3-30-3-30. This is a tool that I've used in the past on pitches that we've done. And what it represents is if you had 3 seconds with people, and let's look at real world experience. This is the most you usually get. Think of the common opportunity you get to introduce your company is when somebody introduces you to someone. For instance, this is Trevor. He works in investments, and I'm introduced to somebody, and the person says, "Oh, what do you do?" So they've got a question. They're engaged. I have 3 seconds. People don't want to hear a 5-minute spiel about what you do. They just want to know quickly, what do you do? Oh, I work with a specialty private investment and consulting firm here in town called TAVA Capital. Oh, really? What do you specialize in? Because I said specialty. I said something that they might ask a question. If they don't, I leave it. They at least know from that 33 seconds what I've done. And if they ask me, okay, what do you specialize in? Then I have my 30-second pitch. And it's not even a pitch at that point. It's conversational, but it's capturing the key elements that I want to be known about the value that we offer, the value we provide. And so the more you can get that on point, the easier it is to expand them and apply it to larger presentations. Because after that, maybe the guy, after I give my 36 pitch, he says, well, I've got a buddy that does this, that's looking for exactly what you're doing. I'd love to learn more. What else do you do? And then maybe it becomes a conversation, which is your 3 minutes. Focus on those 3 minutes, and I'll tell you why. Those in the first 3 minutes, I don't know many people who have invested for a long time that don't know whether they like the investment or not within the first 5 minutes. It is always very fast. From there, you're just trying to, if you like the idea, you like the opportunity, from there you're just trying to eliminate things that would kill it. And that's why we're going to talk about the elimination game. After that, you're just trying to kind of test yourself if the opportunity that you see in that first 5 minutes still exists. Nail your first 3 minutes. And from there, when you're building your 30-minute presentation, it is all bolstering confidence from data, from the things that you are not missing, that you're giving confidence that you can execute on what you just said you're executing in that 3 minutes that you nailed. Behavioral psychologists and whatever they've mated with mathematicians or whatever claim, and you've probably heard this, that when I speak to you today, when you speak to other people, people remember 7% of what you say. I've heard between 6 and 11, but 7% seems to be the standard. That is 1/14 of what you talk about. The rest is wasted. It's not. But the rest, I mean, if they're going to remember 1/14, you want to control what that is. And just a tip, usually that's a fascinating fact, especially with investors. They're typically curious people just like all of us. Fascinating facts resonate and you remember them for a long time. Or it is the magnitude of the opportunity that you're presenting that they think is definable and executable, and hopefully by you. And so that is the 7% you want to make them decide, I like this idea. And then the rest is the elimination game. That's part 2 that we're going to talk about. Again, I don't want it to seem like investors are as diverse as anybody else. I mean, it's not like a cultural class or anything. They have the same thing as everybody else: basic values, certain constraints of what they can and can't do, and certain beliefs that may or may not be true. They all have that, just like the rest. They're not trying to exclude you to be a jerk or to be condescending or anything. It's just the probability of having a good investment is very low. And I was talking to Orlin and Missy the other day. Orlin goes, I don't want to be offensive, but sometimes it feels like investors just guess. And truly, sometimes the result is as though they just guess. I mean, you hear all the stories about the monkey throwing a dart at the dartboard and their success to the professional investment world. The best thing, it's not a guess, but really it is the probabilities are of a sort that the best thing that investors can do is eliminate what they know doesn't work. If you're weak in certain areas, they'll find it, and they know what makes businesses strong in those areas. We'll talk about that. The second one is usually if they've had a bad experience, or they know somebody that had a bad experience. If if they can associate what you're doing with somebody else that failed, that's a hard mental break. And that's kind of why you want to keep them with your story, to keep them engaged in what you're doing, not how it relates to what somebody else did that failed. And so, back to the eliminate, what is the basis for the elimination? It's usually if they've had a bad experience, which all investors that have been investing have. They've had zeros. And it's not like, one error we see from some investments is they'll treat it almost like, well, you knew this was statistically possible, but once you lose money, it's like being cheated at Monopoly, compounded by every penny you actually lost. That's the emotion involved. And so it becomes very personal, even though all of them know that there is a certain percentage that are likely to go down. But the basis that a lot of people will use is some framework that they've built of where weaknesses and strengths and opportunities and threats come from, and typically it's kind of, I don't know, it's rudimentary to talk about an undergrad business school topic of Porter's 5 forces, but it usually revolves around the consulting industry's Porter's 5 forces, which is actually 6 forces, which there's a 7th, which I thought I knew, which wasn't the one I thought it was, so I built an 8th because I can't source if Porter really came up with the 8th one, but I've got it up there. So can we do the one other slide that's there, and that'll show these forces? But if you look, just one slide, that one other slide. When they're trying to eliminate you, they're trying to see how structurally sound your strategy is. Is it one more? Is to some of these common elements. It doesn't have to be Porter's 5. Most investors won't even admit it, that this is it. Even if this is the basis of their structure, it all relates. And it's some framework that will come around this. There's this business model canvas that Orland's put together, or that Orland has, that I've seen the original and like Orland's better. But you can relate these directly across. I mean, you look at what's the cost structure. Well, that's what is the supplier power. What is it really going to cost you to get this in? So they kind of translate with each other, most frameworks that are used, but it's going to be something similar to this. And this is very common. It's very rudimentary, but this business model canvas is exactly perfect in the same way. If you can think of it that way and translate it to what it's meaning here and vice versa, you can kind of see how these frameworks are built, and they're usually testing your strategy based on this. And it doesn't have to be formalized like this, but they're really thinking, is somebody going to pay what you say they should pay so your business works? Somebody willing to pay that? That's buyer power. Can they find that product somewhere else? Substitutes? How hard is it for somebody else to come into your business and take it out? Based on these business model or business plan canvas model that you've got up here, what's going to threaten your revenue streams? What's going to threaten your cost structure? The new ones, so these are the 5. What's your industry competition landscape? That's what people are thinking of. Oh, you want to build a new restaurant that's going to compete directly with Chipotle. Well, maybe people are going to associate you with Chipotle, which was a great thing a year and a half ago, and not so much anymore. Now they had a bad experience, or possibly, or they know somebody that did. The new one that he put was complementers. This was probably in 1996. This is Harvard professor Michael Porter that came up with this. 1996, I think he did complementers. It was a few years after the 5. That's super relevant right now. If you don't have a strategy that can complement or satisfy somebody's reason why you don't complement Amazon right now, there's not an investor in the world that thinks you'll survive if you have a product going out there. If you don't have a way to compete or complement what they already have structured that can benefit your customers. Complementers are big. Industry mindset.
So that means taking advantage of
what's out there, yeah.
Of the engines that are already out there which are generating revenue.
Exactly, because that's going to kind of give you tailwind that you need to kind of go along and help other groups. And Amazon's 2-day shipping might be that complementer, or if you have a better way of getting your product to people, that can be, as long as you're addressing these. You don't have to have them all perfect. But if you know where those threats are and you communicate that properly to investors, and that you have a strategy, or if you don't, that they trust that you can build a strategy to beat that, they won't eliminate you. As long as they have confidence that your business is sound. The seventh one I was looking for was government or regulatory. This has happened and been a big force factor in my industry since 2008. Regulators have built massive revenue businesses because of all the regulations coming in, but in addition, they've shut a lot of firms down. That's global. We can talk a little bit about some inside things happening in China right now, but they're using it as a way to I won't go into too much, but to talk about supply and demand, using the government regulatories as an excuse to control that. And that happens here too. But that happens globally, and so that's a big one. Industry mindset's the one I didn't really know about, but it makes sense. It's kind of saying, nobody likes typewriters anymore. If the industry kind of agrees that it's not a good place to put money, then it's going to be hard to get investment capital that's just not popular. And some of that. So these are kind of things going on in their mind. It's usually a framework, similar business model canvas. If you don't have your value proposition right, if they can't see what value you're providing, then you've lost them. Your story, their story's not your story.
So, how as an investor do you look at somebody who's got a new market that they want to open up? So they have a new product, a new entry that there's really not anything similar to what they're offering. How do you view that? Especially you're talking about some of these ideas of things that they're categorizing. That kind of throws some of this in a loop, right? Because now it's a big unknown.
Yeah, so you're looking at what you want to do is provide confidence that you understand your customer needs and customer segment to prove that there's a demand there. It's all back to the demand and supply. Mm-hmm. That whatever that market is, it could be, buying popsicles in Antarctica or whatever it is, as long as you can prove out that there's data and there really is demand there.
So like a good example would be self-driving cars.
Yeah.
Right? I mean, that's a big topic for me.
Sure.
But there's no market for it. There's no product right now.
But people can see the demand.
It feels like there's pent-up demand for it.
Yeah.
But it's a really risky sort of a thing, right, from an investment perspective.
And so this is even more key to have your story straight, because what you're doing is, if they can picture, that you have some semblance of knowledge and control over your customer needs, customer segments, that there really is a demand, like for self-driving cars. If you can give your investor the picture of what that looks like once that is in place, and give them the confidence that you can supply that then they can see it. And for me, I do use a lot of picture that. Data is important to me, financials are really important to me, and the ability to see the picture, like almost literally like a picture of what is this if it's successful, and what's going to break that down. And if I don't have barriers to eliminate that's going to be successful, then that's how I get past it. So it's key to have your story and your vision communicated properly for that. So I think does that answer your question? Great. So these things, I mean, if you look through this, another thing that I would think about immediately when you're talking about is what is your intellectual property around it, because if it is that great of a market, what's the threat of new entrants? How are you protecting that? What is your strategy to get there first? Is it a first mover? Is it a better mover? Is it a direct utility patent? What is it that's going to keep others out if it's as great as you say it is? So that's a big key for me. Let me see if there's anything else I put as there's just bad experience. You can't control if somebody had a bad experience in investing in what you had, and that can come from anywhere. But you can influence their perception of you and your competence and ability to execute, and that's all you can control, so control it as best you can. Let's see if I had any tips from this. Don't leave any doubts that you are able to execute, and also we talked a little bit, don't be afraid to communicate weaknesses and threats that exist, even if you don't have a solution.
Completely agree.
Yeah.
Gosh, completely, I couldn't agree more.
That's
my contribution to that.
Yeah, no, that was perfect, because it comes in a lot. The ability to say I don't know is really key, because if you don't know, they know you don't know. So it's better to admit it than to.
And if you make up fluff,
Yeah.
then it taints your entire perception of everything that they're saying.
From the story, it goes away and then it becomes a game in the investor's mind to
Right.
trap you. And they're like, really? Where'd you get that data? So, especially because a lot of business ideas, a lot of these things interrelate, and you run into a similar problem in a completely unrelated business that you heard a pitch from a week ago. And so when you're saying something completely conflicting, then it becomes well, is what he said true, or is what you said true? And so you just want to make sure that you're on point of what you do know. With that's pretty much the first two, kind of the trades elimination game. Make sure you are more focused on what message they receive and remembering in that 7%. Getting your strategy on point. Are there any questions up to this point? And we can talk a little bit more about the investor mindset or kind of that. Yeah.
So I have a question, and it's more something that I've experienced through other people's eyes. Almost everybody with a business idea needs money, right? I mean, that's kind of universal.
Yeah.
I think one of the things that people struggle with is, where do I get the money at what stage?
Yeah.
Can you offer your perspective on that and what you know? Because you obviously get people who are at the wrong stage for you
Yeah.
coming to you. Just kind of share your experience about how you would best guide people based upon the stage that they're at with their business.
I think this is great, and actually this plays into this next of the investor mindset. It's difficult for people to comprehend, equity investment. A lot of times when people come and pitch, first, second, long-term investors, there's a disconnect of what capital's purpose is. And sometimes it's just, well, equity capital means I get free money that I don't have to pay back until we're all successful and then everybody's happy. It's the wrong way to think about it. So the way that I would frame exactly what Orland's question is thinking of it as a mortgage debt. Think of how much you're paying for that mortgage to get to what point. And from the investor's mind and the way the investors think, you want to put the structure and capital in correctly for what it makes sense for you to be paying for that will reward the investor. You need it to be in that intersection of the investor's making a resolute return for his risk that he's taking. And we'll talk a little bit about that. But that it makes sense to both sides. And the way I like to think of that is, what am I trying to accomplish, and what is the cheapest cost of capital I can get to accomplish that? And so if you are looking to get investor money because you don't want to owe a bank money, but in your financial model you're making a 5 to 6% or 10% or even 12% maybe model cash on cash return, you're not ready for investment capital. You should go to the bank and get that money first, because the bank is going to have a lot cheaper cost of capital. If what you're doing fits in the realm of the Small Business Administration, well, they have backing that doesn't require collateral on your part, and so the cost of capital from their risk perspective is lower. You might be able to get something for 4 to 6%, whereas if you go to an investor and say, I want your money, and they say they're going to structure it in a mezzanine debt type security, well, based on the other opportunities they have to use that capital, you have to look at where is the risk I'm putting them in relevant to the other opportunities they have to put that exact same dollar amount to. And that's how you should pick where you should be going for that capital and what structure and terms you should initially propose. And so on to the investor mindset that'll continue this answer. Does that kind of answer it a little bit? Yeah.
So can we just dumb it down just a little bit?
Yeah.
Because you use some big words that I'm sure
Sure.
some people aren't going to understand. So I've just got an idea, right? I've just got an idea. I don't have nothing else,
Yeah.
right? So where would you advise is my lowest cost of capital at that point?
At that point, it's friends and family is typically where you go first. After that, you see what collateral you can provide to a bank and get the cheapest source they have. Like I say, if it fits a Small Business Administration, something where the government's going to backstop it, it cuts the risk from the bank and they can give you a lower interest rate, go there first. if it's at that level, right? I mean, so first you're looking at friends and family and your own capital, then you're looking to leverage things that will cost you less. The problem there, and Orland touched on this, and I think Brandon did too in the financials, is that's burn money once it gets to the bank. They have current cash needs that you're paying every day, and that's the advantage of the investor equity is it's deferred. But that can be a double-edged sword because it's deferred, but there is not, if somebody, and my handout will have the different areas of the capital structure. You start with bank debt, which gets paid off first and foremost, down to different structures, pretty much infinite structures of mezzanine debt to preferred equity, which is pretty much the same thing, and just kind of, it's almost shades of gray that change a little bit. And then you go to the common equity, which is the last person to get paid, but if things go amazingly well, the one that gets paid the most, right? Those are the two kind of barbell ends of how capital gets paid back, and so the risk that you're taking, because if you're the last one to be paid, you should get the most reward because that's the biggest risk area to be in. But if you're the first one to get paid, where, you know, I'm getting paid back even if it costs him his house, you know, if you've got that collateral on the line, then that's the least risky, and so you can take a smaller percentage interest rate for your risk, and that's what bank's job is to do with the small business administrator.
So what you're saying, I think, is that initially, if you don't have much more than just a concept, then what you're trying to do is get the cheapest capital possible, which is probably either people who know and love you who are willing to invest a little bit in you, or a small loan that hopefully is backed by something that reduces your risk relative to what you're putting into it.
Exactly, and so say that you aren't in a position where you can get a bank loan, doesn't make sense for what you're doing, you're in a really risky situation where this is a concept, it's a new market, it's a new product, I really want this out, and you are gathering money from usually friends and family or maybe some other investors that are willing to take that level of risk. What you need to show them is that reward on the other side is magnificent, and that really is. When we come into we're going to talk about 3 motivations of investor, that's kind of where it comes from. That reward has to be at a probable level enough that they believe they'll get paid back for giving you money that they may never see again. And remember, if they never see it again, it's gonna hurt both of you for a long time. And so you want to kind of match that up to the best possible way you can. Is try and go with the cheapest cost of capital, but if you don't have enough cash burn that you're going to burn out and fail before you can pay your first month's rent for the capital you've borrowed, then you need to be willing to show that this has such an opportunity and capacity that there is a magnificent reward at the end for trusting in you now. The longer that period is deferred, the bigger that reward should be. And that just goes back to how money changes value over time. But we'll talk about the 3 motivations of investors first. I made a thing. They want to be proud of something that they've done. If they're going to trust you, that's your friends and family as well. They want to be able to look at something and say, I helped build that, or I helped fund this orphanage even. It's important for them to get some internal satisfaction or even recognizable to others on a big level, or even just friends and family, that they were a part of something that worked, that was big. Cost of capital, if they think there's a big social impact or something that they really care about, that actually takes away some of what in their mind they're thinking I need as a return to make this justifiable.
I've seen that.
Yeah, it's a growing thing where people want a social impact or some beneficial societal impact that they're willing to accept a little more risk for a little less potential return. It is a subset of the investment universe, so if you're talking about the constraints you're putting on the capital that you're doing, I wouldn't depend on that for everybody you go to, that they're just going to see the same social effect you do. You might not have that the same values, and back to, everybody has beliefs, values, and certain constraints, whether it's capital or whether it's mandates that some investor or institution has. Second, after the impact, they really do want to see the potential for I got monies that is requisite for where you've come to me and the risk you're giving me. How much cash are you making month over month? And if it's none, if it's just a concept, well, the long-term big picture needs to be a big percentage rate. And you can kind of look at the investor mindset kind of stabilizes over time. Even though the long-term stock market return is about 8%, maybe 9%, even when you look at when it's over the long term, this run-up we've had in the last 6 years, most investors think it's 11 to 12. And it should always be 11 to 12 because in the best period of time, it's kind of like your golf game.
Yeah.
I hit a great score one time. That's my
I'm a
you
bogey golfer.
treat it like treat it like that's their handicap. But in reality, 11 to 12% is usually a standard risk premium for equities if you're investing in stocks. And so you look at that. Well, what does that mean if it's debt? And usually, if it's some high yield debt structure, they expect between 8 and 12%. If you're investing in treasuries, it's whatever the treasury return is. Which varies, but people still think that should be 2 to 5% when right now it's 2 for long-term treasuries. But so there are certain little places where they gravitate, but think about that up the structure, and I would think about it in about 6 percentiles. 6%. The minimum any private equity or venture capital investor is going to expect to receive from your return is an annualized return once they get their money back of at least 18 to 26%. Usually it's 26 to 33 that they realize, oh, some are going to fail, which more fail than that. The actual long-term return is really, really good right now in certain areas, but closer to 11, 12%. What people really think that they're public liquid equities, the risk of being able to trade something day in and out and you have liquidity, really the privates where your money's locked up for a long term, that's part of the risk that you're providing these investors, should demand a higher premium, and so in their mind it does. So think of that when you're building your financials. What is the potential return of what I'm offering them based on the demand I think there is for this product? And if it doesn't fit that it's potentially going to blow up to that level, you probably don't want investor equity capital, and you're probably going to end up paying somebody, even if it's structured that you think it's like an equity because it's termed a private or preferred equity. It's going to be structured more like a debt that'll be looking for, in favorable times 8 to 10 minimum plus upside of whatever the equity does, but typically 10 to 12% that they're looking for in kind of a debt return on that kind of hybrid. It's kind of debt, but it's a lot of equity too, in that. And so think of that when you're structuring what you think your business capital should go to. And maybe that's a little bit deeper, more complex than.
I loved it.
Well, good. Hey.
My hand's on fire.
We got one fan. We got one fan. But typically people do. They kind of baseline their minds in long terms, and some of them aren't empirically real, but it's still what people think it should be. And oftentimes it is. We don't have the returns of what the exits are because there are very few exits of the last little vintage of private investments, especially on the venture capital side. But they look really good because the valuations look really good right now, except there's no IPOs. Relatively no IPOs. So think of what that means. That means when people get their money back, because the IPO is the exit, and the exit means that people that put money in are getting it back. But on these private valuations, it's going up and up, but that's not cashing things out. It's just upping the value of what they say they own, but they can't go to the bank and get that equity out. Yeah, and so we'll see what this turns out to be, but it goes in cycles just like the rest of markets. The last one, and the most important kind of way that the investor thinks is what did you do? Is the remorse of once it goes badly. I mean, there's especially if you're talking about high net worth investor, male or female, there's not a female that's, put $1 million somewhere that got to zero that their husband's like, I told you we should have just bought land. Land and bunker in it somewhere out in away and a Tesla. And instead you invest in this guy. He's got a Tesla. I don't have a Tesla. You've got my Tesla. There's no money left, and you don't want to be that guy. And so they're always thinking of that risk. And when you think through an investor's risk, think very personally to that individual's risk. So say you're talking to the head of an endowment or a pension that runs $20, $30 billion. Their risk, though it is the capital they're investing in you, their personal risk is standing in front of that investment committee to say, I made an investment that went badly. It's the reputational risk they have of putting a bet on you, and it's their job risk, universally. And so somewhere their decision making is going to gravitate towards those risks that they have. When it's an individual, think of what that their spouse is going to complain that you didn't just buy land in a bunker and a Tesla. It's that risk of being wrong that overshoots oftentimes the return and the impact care that they have. It goes in cycles too. I've seen this a lot of times. If investors have a good day, a good week, if their stock went up, they're like, I'm rich. And literally the next day the stock drops and they're like, I can't afford anything. And so literally you can't control that either, but the mindset and the emotion of the investor matters. And you can't control that, don't try and control it. Don't be like, did he have a good day today? Okay, we're So, and other things you can do, I mean, respect that the investor is taking a risk on you. And what that means, it does get personal, especially when it goes badly. And so respect that there is a purpose of capital. If you can give them the reward they're expecting and make it go and give them the confidence you can give them that reward, it is a partnership in that respect. Even if they give you $1 and never talk to you again until you give their money back or report that there's no money left, either way, it is a relationship, respect that. Things that are important for me to see, just really quickly, just some of the specifics. I really need to see a viable financial thesis. And for me, this is to match exactly what he's saying. Are you coming to me with the right structure, the right investment at the right time for the risk that you're proposing? Because if not, it just doesn't match. Think of the elimination game. It's a matching game of, is this something I'm looking for, and does it fit the profile where I think I should be returning based on the opportunity and the prospect that you've given me that I'll get the reward that I expect to get. And so you look at a lot of these technology investors, that's a very binary bet. They're saying, if I'm going to bet in this technology, this Facebook of whatever zoos or whatever it is, I don't know, the end reward is so magnificently binary up that it's worth the little option I'm paying on it now because the dollar amount is so high. So it's almost like paying an insurance premium of, well, I might make a lot of money. It's a reverse insurance premium, I guess. This could be a lot of money, and so they're willing to risk that amount. But think of that, if it's a cash flowing product, and you're talking about returning to them 4 or 5%, maybe if the product goes well, that's probably not worth the risk that they're taking, being that they could go into a corporate bond of Apple or IBM or whatever. So I look at that very deeply. I always want to know, what is it I'm buying? And what are you asking for? What am I buying? Are you just looking for me to lend you money? You're just going to give me 12% year over year in a monthly paycheck or whatever? Or am I buying a preferred security that has some combination of debt and equity attached to it? Am I just buying common equity where I'm in the same risk profile as you? It's important for me to know that your money is at risk first, that your money, blood, sweat, and tears is into this before I lose out. If I think there's a disconnect there, anybody's out. If there's a disconnect, it's called the agency theory, where you're invested. Whether that's personally, sweat equity, whatever, you need to be invested. So I need to know that. Are you looking for influence? Like, if you're going Shark Tank is the one place where you can't have a perfect pitch, because if you know you've got a product that has a certain profile and a certain revenue, you can game that show. And if you can get on the show, you can kind of tailor your pitch to be able to be invested by somebody. So are you looking for influence from somebody? Is somebody like the CEO of that FUBU, if you're putting an athletic, it might make sense to have him to have his name attached, or if your customer base is NBA, it might make sense to have Mark Cuban on the tombstone of your owners or whatever that is, cap table. So I want to know precisely what are you going to do with the money that you receive. I want to see a use of funds, and the more specific you can be, the more confidence I have that you actually have milestones that you'll execute. So when I pay you, is this going to go for your Costa Rica vacation, or is this going to go to a capital expenditure of a machine or equipment, or is this going to go to a marketing campaign that will triple your sales? I want to know where that line item is budgeted, and also I want to know who else is invested and who else is involved and the key players on your team. Because I need to know if your CFO is driving the whole thing and he's the brains of the operation. If he leaves, we need to have a talk. I just need to know who's involved and have confidence that the rest of the team can make things happen. What else? I want to know that you control and demonstrate that you have industry expertise. If you've got a subscription type model in your business model, you should know your monthly recurring revenues, your annual recurring revenues, whatever ARR, MRR, your lifetime IRR of a customer. So if it costs you $1 to acquire a customer, you need to be showing that the lifetime value of that customer is at least $3. Because if it's under that, it's likely to fail your business model. There are certain kind of metrics and milestones you just need to be able to hit and show to me. Beyond that, the most important thing, and just to conclude, the most important thing about pitching, I would say, and I'm in this situation, we're in this situation, you know, raising capital, it can be terrifying, it can be intimidating, you can think, you know, I was overbearing, but really, just do it. Like I say, we funded things that were the worst. I had one that was an engineering group that they literally put 3 6-inch binders on the table, as though we were going to go through those 3 6-inch binders. Like, there was no real presentation, it was like specs of machinery. I'm like, what is this?
Doing that.
But then they said, this is our biggest customer in this state, here's their LOI, they're going to give us this much money, which was a 10% premium to the valuation they were offering us on the entire company. And so just that metric, saying you're de-risking us on an LOI, that once we get this technology working, which it's already been de-risked by these engineers here, which we trust because they were big government labs that were testing us. They'd given us that confidence that, yeah, there was a high likelihood, a high probability that we would get this cash early on. And when one is there, it was kind of a business model where there's no take. So it doesn't need to be a perfect presentation to get the investment, so just take the meeting in case you have an imperfect presentation or pitch that ends up getting the funding you need in the terms you're happy with, by people you can spend the rest of your life with. And that's what I recommend. So with that, are there any other questions or thoughts? I can give you anecdotal things on other deals that, you know, we had a biotech that it wasn't 3-ring binders, 6 inches tall. It was like infinite data. One other point on the data, you do have more information than they need beyond that 30 minutes. I just like to know what's available, and I like to have access, especially on the financials portion. I like to see the formulas and the assumptions you're making on those variables. Just give somebody a link to a data room. It's just a Google folder that you've sent them a link, and they have access to your financials and your models and your patent technology, so they can see it themselves and go touch and feel it without you giving them 6-inch 3-ring binders. Which was all right. But any questions?
You know, one thing is, I think you already covered this, but the two things what I noticed before was it's helpful to have if at all possible, a working product, so like an MVP, and also I want to know about your team.
Yeah.
You kind of covered about the team, but kind of like the working kind of product, even if it's just like kind of simple, so you can kind of play with it a little bit. Kind of like help them imagine like what this can like really be like once it gets more refined.
It's an opportunity to show your marketing prowess when you're there. So the minimum viable product, if they can look at and feel and touch that and say, this is great, and I can see where it's going, and with capital to put it to refine it. That's great. Content marketing, 77% of Fortune 500 companies and even mid-tier companies are putting most of their budgeting dollars on content marketing, which is the fascinating facts. If you can increase their knowledge or fascination with something, that's proof that you can go out and content market and actually get interest from your consumers. Video is a huge space right now. If you can have compelling and interesting video product that you can show in a presentation. So that can sometimes replace your minimum viable product if you can CGI the actual product. Things like that. I mean, it's an opportunity to show your prowess in that. But yeah, that's a good point. I heard Orland talking about the minimum viable product, which I agree with. We've had companies we've looked at that 6 engineers, 1 sells. That's the wrong formula. Not the engineers are bad. They were a product. They needed to get product out. And if they've got a 6-to-1 ratio of the people getting the actual product out and to the people over-engineering it literally, then it's not good. They turned it around and did well. As we did invest when we looked. Anything else? Any other questions?
Well, when it comes to team building, what's
Yeah.
like your minimum, your ideal model is like, do you have, your separate whole financial branch where you've got your bookkeeper auditors, your accountants, your lawyers, do you care about business entities, whether it's, you've got a structure that's just like a limited partnership or an LLC? What's more attractive?
Mostly, all I care about, and taxation does come into the picture, but usually not in a startup, not in that early stage. Typically, I look more that the structure makes sense. If it's if you've got a C corp when an LLC fits better in the stage you're in, it's kind of similar of when you're coming to me for capital. Match the structure to the stage, and you can usually find, literally, you can Google almost any business. What kind of structure should this business entity be in? Don't overcomplicate your business entities because it can come across really confusing to the, it's not that it's confusing to the investor, but sometimes it can come across, well, you're really early stage and you have this complex a structure or ownership structure, and it kind of looks like maybe you're moving money from point A to point B, and that can be tough. Like, again, and what do I own? Well, we've had that before where you're presenting the master parent company, but I own like this little piece. And a lot of the one we found, it was preferred, but the preferential is we were in the first risk position in the last pay position when you look at it. But that was literally a 60-page document to like look at that and be like, I know you called it better, but this is way worse. So just make it match this structure is what I'd say.
I really, there's expectation on risk return
Yeah.
is purely a relative and subjective calculation that they're running. And it's based typically off of things that we have no idea or ability to foresee.
Yeah.
Right? Because it's okay, I expect X on my dollar in comparison to the next best alternative where I could put my money.
Yeah.
And you really don't really know where their next best alternative is.
Or if they have a rational idea of what really that other alternative is really returning, you know?
Yeah.
Sometimes you're competing against false perceptions.
Yeah.
But yeah, no, I agree, that's important. Any other questions, anything else?
On the financial modeling that they present to you,
Yeah.
I've actually been in predominantly more of the position where people present financials to me.
Same.
And I've also been the person that's been pitching the financials. And it's been really interesting to see the type of feedback that I'm getting, or the types of things that, when people are pitching it to me, the things that they're focusing on.
Yeah.
Predominantly, people usually are interpreting revenue as their primary source of success, right? I never really cared about that because they're saying, hey, I anticipate the valuation being multiple on revenue. I usually call baloney on that. Predominantly because I want to see what the aggregate and net cash flows look like, where you're going to bleed, what's going to dilute net income even further based off of your capital structure, so on and so forth. Your guys' personal preference, how much granular detail do you like to see? Not necessarily within the model that you have a link to in their folder. You want as much detail as possible.
Sure.
But in the pitch, how much detail do you want here?
You don't need to provide a lot. What I would say is, again, in the pitch, especially in the 30-minute, have that information available where they can get granular where they want to what you have, and let them know what assumptions you're making, because there's always variables that affect the financials pretty significantly. But make it match your model. So if your model is a market share play, revenue is the key indicator. If it's a play to get taken out in a merger and acquisition, it might be the contribution margin, the gross margin. That matters, because somebody else that's taking you out thinks maybe they can do that for a little bit cheaper cost of goods sold, and maybe they can improve the efficiency of your operations and thus make a bigger profit. But at the end of the day, for us philosophically, and for all of the market up until this last few years, it usually is, eventually cash has to be paying this interest back. It can't just be a perpetual increase in valuation. Cash actually has to be made, and it's hard cash, not funny profitability cash that's out there, but actual money returning these dollars, the potential. I care about that deeply.
What about Amazon?
That's what I was talking about. So actually, there was a conference down in Dallas with a bunch of hedge fund managers. I didn't go. I go every year, but one of our other partners did. And he said, one manager said, all my life I've looked at value as the driver. How much cash can this business return to the investment? He says, what if a company becomes so structurally integral to all the parts of the supply chain that it doesn't matter if they never make money for eternity? Maybe that's possible, and that's kind of what Amazon's playing for. They can take the market share of everybody else and just kind of slowly bleed, they'll always have the availability of the capital to keep things running and growing. It's a game like that, and they are big enough that they could probably do that. But that's a new construct, right? And we don't know if that works long term. It hasn't ever in the past. But they're making a good argument that it could in the future. Well, I appreciate it. Yeah.
So, one, just a slight switch.
Yeah.
So, Tech Tank Ogden, we got a competition coming up. You're gonna be one of the judges. And the people presenting are probably not in your target investment market. So we got a whole bunch of people in the concept, pre-revenue state. So what are you gonna be looking for from them in terms of judging them?
Yeah.
And you may not have thought about this a lot, but just talk a little bit about how you perceive that competition and just give them some pointers for what you'd like to see in that presentation.
Yeah. I would say I would keep it to two things that I really look for. I try and simplify how many variables I really analyze in things, even if it's a really complex structure. It overwhelms my little mind way too fast. So I want to take complexity down to little structures, and really in that kind of a case, I'm just looking at the risk reward of, do I really believe in your vision of the potential of this thing? Is it as big as you think it can be, that I can get rewarded at that level of risk that I'm taking, potentially? Or I'm paying an option now to get a really big payoff later, and do I believe you're the person that can execute that? You're selling yourself more than you're selling any product in any given pitch, because they're looking to you. Even if they have collateral of your IP and I don't know any investors that are like, I hope he fails so I can take this company over. It's a bad strategy. It has happened in history, but it's a bad strategy. It's a losing. So I want to know, I want to believe in the vision you see. I want to match that with the risk I'm taking, that I think the reward potential is there, and I want to have confidence that you're the person that can get it there. I want to see those three things, and we have found brilliant ideas, brilliant product technology, operating machine where it could work, but I just don't trust the management team's going to get it done. And that can be a trust issue, or it can be a capability issue that I think they need other resources or somebody else in to help certain part out.
Do you look at if they've done pre-marketing and like how likely is it that this product could be successful, even if you thought they were great and
Focus groups and different,
they know who their market is and
Yes, and I pay attention, and I should pay attention more, and I'll be honest, the mentality of a lot of people that invest, if you're talking to an institution where you've got a bunch of analysts there, they're going to look all over that. But a lot of times in the investors that invest in this space, it really comes down to biases they already have. Yeah, that's huge.
it's an emotion.
This is a great big deal. It doesn't matter what they've done research. I think it's a huge deal. I mean, sometimes that, sadly, and I admit, sometimes that bias does come in more often than not in that stage of companies. How big that could be. But no, it is important to get some of that pre-marketing, that focus group. Surveys are really easy to get out there, and that's the testing market of the crowdfunding. Kickstarters, Kickstarter is a double-edged sword as well. Once you start products on Kickstarter, it's hard to be successful at starting new products off of Kickstarter, right? I mean, it's hard to transition your business model a little bit. Some have done it. Some have made that really well. But going from a Kickstarter business model to a traditional distribution model of upselling, yours to be marked up double at REI or Cabela's. That's a tough transition based on the different fee structures. It's important for me to know, like when you're talking about your cost structures, how well do you understand it? Because there's a lot of fees hidden in things, like Amazon particularly. Amazon will be like, well, we can do fulfilled by Amazon for 13-15%. That doesn't include the shipping charge. They attribute fees to you on top of that, based on the services they're providing. You think it's all encompassing, but sometimes you don't see all of that.
Good to know.
Not to rip on Amazon, Amazon's great. I think it's enabling a lot, but it's also disrupting a lot of business models.
Mhm.
Anything else? Any questions?
Thank you.
Thank you so
Thanks.
much.
Okay.
Yeah,
Awesome.
thank you.
If you enjoyed what you saw or got some value out of it, please like and subscribe. And if you have any questions, feel free to leave them in the comments.